Okay, in this video we're going to be looking at the impact that both taxes, and when I refer to taxes I'm talking about both income taxes, which are progressive tax, and company tax, and the impact they can have on demand and supply, as well as interest rates. And both taxes and interest rates are both demand and supply side factors. So in your answers you need to refer to both the demand and supply side impact. So firstly, interest rates. It's important to remember that it is mainly an aggregate demand side factor. So regardless of whether the demand is shifting left or right, the change in demand will always be more than the change in supply. So for example, if interest rates were to go down, so I'm going to talk about interest rates going down, and it will be the opposite if interest rates were to go up. So the first thing would happen is investment spending would increase, because lower interest rates increase the incentive for firms to invest in new buildings, capital and machinery. Essentially it's less expensive for them to borrow, so rather than say interest rates are at 5%, then if they borrowed $100,000, they would have to pay back $5,000 a year in interest. If interest rates were to fall to 3%, that's only going to cost them $3,000 a year. So lower interest rates are more of an incentive for firms to invest in new buildings, capital and machinery, and that will boost investment expenditure and increase aggregate demand, because the cost of borrowing is less. And it makes it easier for them to make enough money out of this new building to sort of make up for the costs of interest. Second thing that's going to increase is consumption spending. And there's kind of two reasons that consumption spending will increase. It's important to talk about both reasons. The first one is that lower interest rates will increase those who already have mortgages will have a higher discretionary income. So if I already have a variable rate mortgage, then I'm not going to be paying as much money on that in interest in that, and therefore I've got more money to spend in other areas. So I've got more money to spend on consumer durables and single-use goods and semi-durables like clothes and footwear. We also refer to this as the cash flow channel. People have more cash available because they have a higher discretionary income because they're paying less off their loans, and they'll spend more on other things. The second reason is that lower interest rates also encourage people to take out new loans. So if your family wanted to go on a holiday and if you say you didn't have any debt, with low interest rates you'd be more willing to take on debt because you're going to be paying back less off that debt. So there's more incentive to buy, your first house, to invest in, to spend money on a TV, increase your credit card loan. You might spend on computers, holidays, all of these kind of things. And it also reduces the incentive to save, because if I have money in the bank, say I had $100,000 in the bank, I'm going to receive less on that money. So at 5%, I'd be getting $5,000 on my savings. At 3%, I'm only getting $3,000 on my savings. So that's going to boost aggregate demand and economic growth. So the lower the interest rates, the higher the investment spending, higher the consumption spending for both the discretionary and discretionary reasons, and because we're more likely to take out a loan. Obviously it would be the opposite if interest rates were to increase. We would see less investment and less consumption spending. On the supply side, so demand is going to shift to the right. On the supply side, the lower interest rates will also shift the supply curve to the right, because it's going to lower the cost for businesses to finance existing loans, and that's going to reduce their costs of production and make them more willing and able to supply. So any business that already has an existing loan is going to basically have lower costs of production, and therefore they're more willing and able to supply at any given price. Their costs of production will be lower. That'll boost our future productive capacity. The lower prices due to expanded productive capacity will also boost aggregate demand in the long term. So that shift in supply to the right will eventually lead to lower prices here instead of here, and therefore more consumption and export spending as well. So it's important to remember that the demand impact will always outweigh the supply impact. So whenever interest rates decrease, the demand shifts right by more than the supply shifts right, and prices are likely to go up. So I'll draw that in a graph in class because it's pretty hard with this materials, but demand shifts right more than supply shifts right, and we will see higher prices. Taxes. Okay, two types of tax you need to be aware of: company tax and income tax. Income taxes: lower personal income tax increases consumption expenditure because people have higher disposable income. So they will spend more on goods and services, on consumer durables, semi-durables, etc., because they have more money after they pay their taxes. It'll also increase import spending because when we spend more on imports. Lower company taxes, their demand side impact is through investment expenditure. Okay, if we have, basically what we're saying is that firms will be more willing to invest because they know any future profits that they make on that investment are taxed at a lower rate. So they know if they're going to be able to sort of increase their profits by $10,000 a year by investing, they're going to be paying less tax on that, and therefore it's a greater incentive for them to invest and get bigger and generate more profits. In the long term, investment spending will boost our productive capacity as well, but we're talking about the demand side impacts. So lower company taxes and lower income taxes will boost consumption and investment spending. In terms of their impact on aggregate supply, okay, income taxes, it's very easy to refer to most people understand the demand side impact. The supply side impact is a little bit harder. And if I ask you to explain the supply side impacts of lower taxes, and you start going on about increased disposable income, you're not going to get the mark. You need to be focusing on why they will shift aggregate supply to the right. And the reasons for that is that it gives workers an incentive to work hard and lift their performance. So, for example, if I knew that I was going to get taxed on overtime at 40%, say I was working my old job at Australia Post, then I might not work that extra hour because I'm only going to get to keep 60% of the money. But if taxes were low, like 20%, then I'd be more willing to work that extra hour. So consumers will work harder and will also be more productive if they know they're going to get to keep the extra money that they make. So first thing it will do, it will increase productivity, and that will help to reduce real unit labour costs, which we'll talk about, and lower production costs for businesses because people are working harder because they've got that incentive. The other reason lower taxes boost supply, other than just productivity and people working harder, is that it increases the size of the labour force. So with lower taxes, more people are willing to join, more people are willing to work. So for example, let's say a single mother that just had a baby. If she knows that she's going to get taxed 30% of her income, she might decide, no, I'll stay at home with the baby. But if she knows that she's going to be taxed at a lower rate, she'll be more likely to re-enter the workforce because she knows she's going to get to keep more of her money. So lower taxes increase the size of the labour force. That would be the same for the guy sitting at home that's never had a job. When taxes get lower, there's more of an incentive for go and get a job. Higher labour force puts more competition for jobs. People have to work harder. It also leads to lower wages because there's more people looking for jobs, there's more competition. And that lowers cost of production for businesses, reduces pressure on prices, and shifts supply to the right. And again, those lower prices will help to boost our international competitiveness and aggregate demand in the long term. In regards to lower company taxes, so lower income taxes shift supply to the right. Lower company taxes will reduce businesses' costs of production, okay, and therefore they're willing to supply as well, and that will shift supply to the right. Enabling businesses to charge lower prices will boost consumption, expenditure, and net exports. So businesses will have lower costs of production if they're taxed at a lower rate, and therefore they're more willing to supply, and that should lead to lower prices as well. So essentially, like interest rates, lower income taxes will shift demand to the right and supply to the right. The demand side impact will be bigger, so prices are likely to rise, and same with company taxes. Lower company taxes will shift demand to the right, shift supply to the right, and again should lead to slightly higher prices because demand shifts by more. Thanks for listening.